but we do have our final speaker on the graveyard shift for this morning's agenda is Jeremy Lang of Ardevora Asset Management. Jeremy, just to check that you can hear me loud and clear.
I can. Can you hear me?
We can indeed. Thanks so much for joining us, Jeremy. Yeah, I always look forward to hearing what you have to say. My colleagues often laugh at me. I remember when I just started Nedgroup a couple of years ago and we had launched the fund, I hosted you for one of these webinars. I know you loathe PowerPoints. You shot through it in 8 minutes and I was scrambling for about 22 minutes to find some questions. But I've got better versed in the strategy now, and I think some of our clients have as well. We've chatted to a few of our clients recently about the fund, and a lot of them, what they do recall from your first trip here to South Africa is your overwhelming statement that we do not trust CEOs. And I think that really got people's ears perked up and interested in the fund, interested in the strategy, interested in behavioral finance for that matter. And I think, I must confess, you made us look quite smart at the next family braai or barbecue, as you might refer to it, as we all gathered around and we bragged that we knew more about cognitive psychology, the study of bias. I've met some people that said they'd even gone on to read Daniel Kahneman's book, Thinking Fast and Slow. One gentleman said he even went back into the great Greek philosophers of Plato. I think you might have mentioned Plato and how power corrupts, and absolute power corrupts absolutely. So we always appreciate your views. Just as a reminder of the strategy, I think Jeremy's been giving a quick 101 in previous fund manager workshops, so I want to focus more on the questions today. But like I mentioned, the Ardevora approach focuses on cognitive psychology, the study of bias, and identifying mistakes in two key market players, and that is buy-side analysts as well as investors, and looking for these errors and the opportunity that presents itself on the back of that. What you end up with is a portfolio that is a combination of both value and growth, or as you'll hear Jeremy refer to them as easy growth and recovering value. The portfolio, and Jeremy might point this out as well, they have no favorite children, so everything's equally weighted. They're roughly moving between 150 and 250 stocks. So each stock holding maybe just more than 1%. I think about 60 basis points is the average stock holding to date. And then that tilt between growth and value is very much dependent on the overriding market conditions of the day. So on that note, Jeremy, my first question to you, and I really enjoy reading your fund notes, particularly in the course of the COVID recovery. You spoke a lot about the release of anxiety after the initial sort of trauma experienced on the back of the lockdown. But given what we've seen in the last quarter, what are your thoughts on the major sort of the environment over the last 3 months that we've seen?
Yeah, every recovery cycle that we've experienced and studied goes through, I think, a couple of almost standard behavioral sort of phase shifts, if you like. So they always start with that sense of deep trauma and deep anxiety, and a narrative sort of grips the market that it's either the end of the world or there's some part of the world that's about to end, and then somehow it's never quite as bad as everybody expects, and so you then stumble through that path of anxiety release, which always starts with the news not being as bad as feared. And then it starts to shift into a recognition that possibly a recovery is happening. And then you get to the next interesting phase, which is sort of, I think, where we've been this year, and particularly in Q2, which is the debate shifts from not is there going to be a recovery, but how long is the recovery going to last, and is this now as good as it gets? Because, you know, once you've traveled through that path of anxiety, stock prices have gone up a lot. The news has gone from, incontrovertibly awful to now suddenly you've got lots and lots of reference points where everybody's saying things are getting better. And so you have this sort of strange switch in the source of anxiety to, is this as good as it gets? And that's what Q2 was all about. It was that battle of those two narratives of, is how long will the recovery last? Is this as good as it gets? What's going to happen next?
Thanks, Jeremy. So we do have the guys in the background here flicking through some of your slides. I know you don't necessarily like talking to slides. I mentioned that earlier, but there's a slide here showing performance of the fund. I think inception back in October, November 2013. So quite a proud performance. It's been an interesting quarter from a performance point of view. So I don't know if you have any comments in terms of how the fund may have performed over the last 3 months.
Yeah, well, despite some of the stuff that we've talked about already and in some of our, previous chats, in that we like talking about some of those sort of more, I suppose, sort of top-down things, the behavioural cycles of anxiety and the shift of attention people have. But all of those things that we talk about, that they somewhat paradoxically, they all sort of bubble up from below, because we're basically stock pickers. We just like looking at lots and lots and lots of individual businesses and how they're behaving, what the CEOs are telling us, and so on. And then we try and sort of stick all those pieces together to then make some inferences about what's going on from above. But typically we don't really like it when the environment is really dominated by some of these sort of big macro things, because it sort of makes it really noisy and difficult to work out what's going on down below. So I just, that's my warm up to basically say we didn't do very well last quarter, because that sort of cross currents of those two big high level debates means that often I think the way investors play around with stocks is that they use them much more like sort of betting chips for their view on what the economy is going to do in that sort of debate, rather than, if you like, what's really going on down at the bottom, whether a company is doing better or worse than expected, whether the CEO is behaving sensibly or not. So we had a lot of wild moves last quarter, a lot of flip-flopping between different types of stocks, value and growth, and a bunch of areas of the market sort of did well, which we basically don't have very much exposure to, like sort of energy and financials and so on. So when I put all that together, it was a bit of a frustrating quarter for us, actually, without actually doing very much wrong. Most of our stocks sort of did broadly what we expected, but it was more the curse, which you often have as a stock picker, which is the stuff that you don't own that in a relative sense hurts you. So that was really the story of the last quarter.
We had Tony Cousins of Perfit on before you now, and he manages a multi-asset portfolio for us, and spoke a bit about financial repression in the US, rates being incredibly low, where inflation expectations have moved, and I think a lot of people were quite surprised by the performance of growth in the last quarter, given how value had really, and that rotation had taken place over the course of the preceding quarters before that. But you touched a little bit on some of the sectors. I always get a bit excited when you refer to energy, because you no longer invest in companies that generate a majority of their revenue from fossil fuels. But I want to break down some of that sectoral performance in the last quarter. Do you have any kind of high level notes on which sectors have done well and why?
Simple take. Well, there was this weird combination last quarter, actually, which is that energy, which is a kind of classic deep value sector at the moment, did very well, but so did big tech. And those two don't normally cohabit at the top of the performance charts in a quarter, because people normally play with different things when they're investing in those two. So the energy one, I think, is just that there is this peculiar cycle going on in energy. But it's partly because it's the sector that really stands out as having had the deepest scar, if you like, from that huge anxiety explosion last year during COVID. We know lots of businesses got hammered, but oil and gas businesses got particularly hammered, because I don't know if it's amazing when you think about it now, it wasn't that long ago, but the oil price actually got negative for a brief period, which is just completely nuts. I think there was a lot of throwing in the towel on energy companies there. And so I think because they went so much deeper, I think there's a little bit more of there's further to climb on that anxiety. Plus, there are a lot of people like us now who've concluded that what those companies do is just in some sense not really acceptable, so they're not really investable. So they have begun to move, I think, slightly to their own beat. So I think the oil prices continue to sort of slowly crawl up from that crazy starting point, and so I think that helped those ones. Big tech was the kind of counter narrative, which we may have a chance to touch on a bit later. But as well as having that recovery, is it all over or not narrative, COVID is still there, and we've had this big ramp up in the Delta variant at the back end of the quarter, and we're still in the midst of that now. And so there was this, so that flip back to growth was slightly a kind of, we need to be a bit more worried again. And as we've seen through this cycle already, big big cap tech actually has been the defensive play. It's been the one where when people get nervous, particularly about reopening and COVID, that's where they run to. So I think that's why that sector did well as well. And so clearly, because we're equally weighted, that we really struggled to keep up when those big cap tech stocks start to do well.
Yeah, I guess the portfolio had a low risk bias, and in hindsight is a wonderful thing. But if you had to go back, would you have done anything slightly differently?
No, we always thought that this year was going to be a year of just trying to avoid taking silly risks, in the sense of, not wanting to stick your neck out too far, because, there's still a lot of unpredictability to get through in terms of, we're clearly recovering, but we don't know how powerful that recovery is going to be and how long it's going to last. Also, there's significant issues in the ability of the global economy to re-ramp up, just to get everything moving again, which has brought in the inflation narrative. And we've still got to contend with the whole COVID cycle. That's just not gone yet. So there were just so many ways to be wrong. So we spent a lot of time at the start of this year trying to get the portfolio in a shape where we just didn't think we were too exposed to making any implicit big bets either way on any of these sort of big narratives, and just try and rootle around and pick reasonable stocks in a fairly varied mix. But even with all that effort, it's been, we've lagged this year it's been quite tricky, if you like, to not take any of those bets when everything's been flip-flopping so quickly.
Yeah, so we have a slide up at the moment that talks to the top contributors in the past quarter, and as everyone can see in that second column there, just shows the no favorite child that I mentioned earlier. So they're all hovering at around that 50-60 basis points mark. But maybe give us a bit of an insight into your thinking or how you evaluate some of these names.
Yeah, first off, isn't it a crazy list? You just look at the mix of stocks in there, and that I think sort of typifies what we're kind of in a state of flux sort of quarter, because there really is very little thematically to link them together. You've got kind of a mix of what we call easy growth, which is basically they're businesses that are kind of unusual businesses that face an environment where it just is unusually easy for them to grow, and the CEOs, if you like, are sort of lucked out in that environment. But also there are these kind of eclectic mix of recovering value, which are basically businesses where they've been duffed up. The CEOs have made mistakes, but now the way those businesses have been run is that the CEO is thinking about delivering a plan which is all about recovering. It's not ambitious in the sense of, they don't think they're going to conquer the world, which is normally how they behave. It's more about just how do we regain what we lost. So you look at that, it's just a crazy mix. We've got a couple of I think quite interesting, although we tread very carefully out in that area of the world, effectively Chinese-based businesses, which we access through quotes in Hong Kong or the US, which are those two easy growth ones, BYD and NEO. Now those are both essentially electric vehicle businesses. NEO is a kind of Chinese, I use the word knockoff, but it's basically taken all of the reasons why Tesla's been successful and tried to sort of replicate that in China by going sort of very high end. Pushing EV as a kind of experience and a service almost, rather than a kind of purchase decision of a car, being very strong on brand and so on. And BYD has kind of started the completely opposite end, and it was an old-fashioned battery manufacturer, and then has sort of moved up the chain, develops a semiconductor business as well to go into autos. And it's kind of, come up from a completely different way, but both of them can coexist because they've got very different strategies. And when we looked at the EV area, we just felt there was some really interesting stuff going on in China. They basically learned what Tesla had done and seen how the kind of world evolved. And you often see this with China. Then they basically leapfrog a number of intermediate stages. So that's why we kind of got interested in those two. And then you've got Bed Bath and Beyond, which is like right at the other end of the extreme. When I even suggest to clients, some of my clients who are a bit long in the tooth like me that that Bed Bath Beyond could possibly be a viable investment. I mean, they almost visibly wince because that's a business that has been through so much trauma, has been written off as basically obsolete. For those who don't know it, it's a US bricks and mortar retailer. So it's like conceptually in all the wrong places, which sells homewares, basically, furniture and bedroom stuff and stuff to put on your table and so on. They were a fantastically successful business when bricks and mortar sort of category killer rollout stories were prevalent, but then they got really clobbered by that shift to online. There's some very aggressive players in that area, and so which brought that company really to its knees. And then they got then COVID came along and basically shut most of their stores. And it's an interesting one for us because we do run short portfolios, and we did short it on the way down. But they have gone through this really almost like existential crisis of what their business is about, and gone and embarked on a really deep restructuring program where they've just cleared all the decks and really done some radical things. So that's why we got interested in that one, and kind of early signs are it's working, but it's a really, really unloved stock. So that was a kind of quick tour of my crazy world of, you can have these kind of supercharged growth stocks and then kind of, horrible looking deep value stocks all coexist in the portfolio.
I think the final column gives a good sense of the world. I mean, if I look at it every month and every quarter, you can see what the global sort of tilt is happening between the growth and the value from a performance point of view. And we don't have time today, but I know you hold a couple of South African stocks. I think it's Bidcorp and Capitec. And Capitec, for those that are curious, I guess Ardevora's note speaks to how and it's kind of underestimated Capitec's ability to gain market share from the bigger banks. That's from early on to be now one of the biggest, if not the biggest, sort of by client base bank in South Africa, and high transparency from a banking point of view in terms of fees. The other one is Bidcorp. You have held Clicks historically in the past. I believe you sold it on some change in rhetoric from management, which is quite interesting. Unfortunately, we don't have time to go into it today. But my final question for you, Jeremy, is, and maybe a quick 1 minute answer, is how do you see the markets and the world playing out over the course of the remainder of this year?
Well, I kind of, so I paused there because I don't normally say this, but we are surprisingly optimistic, actually. Everywhere I look, there's exciting stuff happening. When I look at growth, businesses that have got growth plans, I just see there's so much happening. All of that disruptive stuff that we kind of got familiar with pre-COVID has all been hugely accelerated by COVID. And so, there's some incredible changes going on in just the whole way businesses operate, consumers consume, which is very, very exciting. But at the same time, there are so many interesting recovery restructuring plays out there as well. Businesses that have kind of been pushed to the brink and been forced to really think about what makes them a viable business, and have embarked on some pretty serious recovery plans. Whilst all of them, everyone's saying that the pace of this recovery is still exceeding expectations. In fact, that everybody's struggling to keep up now with the pace of recovery. So, and there's liquidity everywhere. So I feel kind of strangely optimistic because I'm normally a pretty risk averse person. And but yeah, it's a really interesting time.
Okay, it's absolutely refreshing to hear, and I know you 3 portfolio managers on the fund, and you divvy up the stocks equally, so you're looking at a bunch of names, and we always ask the question, how big is your universe? And what you've just said now illustrates that there's plenty of opportunity out there. You guys are always generating new ideas. I know your investment team is growing. I spent a day in your office last year, and off the top of my head, you have quite an eclectic mix of a young, energetic team. I think there was a European historian by academics. There was a molecular and was it chemical biologist. There was somebody, I don't even know what they studied. It was something like molecular magnetic resonance. Sounds like rocket science, but too smart for the likes of me. So quite a eclectic mix of individuals, a young team, diverse skill set, and I think we're starting to appreciate that in fund managers as well. So that's all we have time for from you today, Jeremy. So thanks so much for dialing in, and I'm glad your tech seems to be working in London.
Lovely. Well, great to catch up again. All the best.
Okay. Take care. So that concludes our morning for today for our Global Fund Manager Workshop. Thank you so much for joining us, as usual, from myself, David Levinson, my colleague Anil. I believe a QR code will be showing up on your screen shortly, so your feedback, as always, is greatly appreciated.